What is up, guys, and welcome to Lecture 8 of the TCT Mentorship, where I'll be teaching you everything you need to know regarding PO3 schematics. And as some of you might notice, this video is recorded the 22nd of December 2024 and was not included in the original launch of the TCT Mentorship back in the beginning of October. And this was mainly because I didn't want to information overload you guys with all these different schematics, and I truly wanted you to have the focus on being able to identify good looking TCT accumulation and distribution models. Because a PO3 schematic will be traded in the exact same way as a TCT accumulation or distribution. It's just a way of building advanced context to potentially extend your target and therefore increase your risk to reward. And now that you guys have been practicing and studying the TCT models and are slowly getting more and more comfortable trading it, I will slowly start to add different types of advanced details to the mentorship to truly prepare all of you for every market scenario. So before I'm going to dive into the PO3 schematics, I want to clarify that this is not something that I have created. It's already a well-known smart money concept schematic out there. I do just have my own unique rules in order to validate a PO3 schematic that I will be sharing with you guys here today. So, what is a PO3? A PO3 stands for a power of 3, and it's a manipulation play in the market to trap retail consisting of 3 phases. You have your range, you have your manipulation, and then you have your expansion. In a bearish PO3, you will have a range where price ends up breaking out of that range high, manipulating above, and then getting acceptance back inside, having a full-on reversal back down in the expansion phase. You have a range, you trap retail into thinking that we're breaking higher, and then you're reversing back down. Range, manipulation, expansion, power of 3. In a bullish PO3, you will have a range and you'll have a deviation of the range low, manipulating below, getting acceptance back inside, and having a full-on reversal back up. So in general, if you understand the foundation of accumulation distribution models, you will understand why the manipulation is above the range high and therefore causing it to reverse back down, because it's a way to trap retail into thinking that we're going higher, where breakout longs get opened while also sweeping the liquidity of that high and then reversing price back down. So it should already start to make sense as to why they're deviating the high, why they're deviating the low, and what follows from it, which is the reversal in the opposite direction. So, to validate PO3 schematics, I have different types of rules for each of the phases: the range, the manipulation, and the expansion. So we're going to start off with the range requirements. And the range requirement is one of the most important requirements in the entire PO3 schematic. And in order to have a valid PO3, in your range, you need to have a good return to zone building up prior to deviating your range high. Okay? This is absolutely key, and it's super important that you have a good return to zone within the range prior to breaking out of the range. And this can be through the creation of a liquidity curve or a trend line, which is explained in lecture 4 of the mentorship. It's absolutely crucial. You need to have a good return to zone within the range in order to have a valid PO3. Now, it is even better if you have price compressing within the range, building liquidity on both sides. What I mean with that is means that you have a range low, you have a range high, and price is tightening up inside of that range, building liquidity below and building liquidity above, and then it starts to deviate on either side. Okay, in this case, we're deviating the low, and we could have a potential bullish PO3. And the reason why this is even better is because it shows just even more that the market makers are purposely sweeping that obvious looking sell side liquidity in this case, allowing them to fill their long positions for a potential reversal back up, right here on the left, you don't see that much buy side liquidity at the highs. So you're not sure if, they're truly sweeping buy side liquidity for a reversal back down. But if you see that obvious looking liquidity, okay, they can sweep all of that, deviate it, and then reverse price back up. While also, if you are compressing inside of the range, you most likely have some sort of a retail pattern, like a bearish pennant or whatever they like to use, which is like this triangle compressing effect, and then they will call for a breakdown. And oftentimes when you have this compressing formation, leaving liquidity on both sides, the first move tends to be the fake move to trap all these retail pattern traders, okay? So whenever you have this compressing effect, building liquidity on both sides, and then you move in a certain direction, that tends to be the fake move, adding extra confluence to the power and the strength of your PO3. So to summarize the range requirements, you need to have a good return to zone building up prior to breaking out of the range, aka deviating the range. So now we're coming into the manipulation requirements. And obviously, whenever we have a PO3, you don't have a range breakout, but you have a range deviation. So you want your manipulation price action to not close above the DL2, like we've shown you in lecture 2 regarding ranges, okay? So your manipulation phase needs to be inside of your deviation limit. It can wick above it. It just cannot properly close above it, okay? Now, in order to have a valid manipulation phase, you need to have a TCT model inside of the manipulation range. So price breaks out of that range, stays inside of the DL2, has to create a new range that then ends up having its TCT model. In this case, of a bearish PO3, you will have a model distribution. Okay, it can be a model 1 or a model 2. So you want to break out of the previous range, stay inside of your DL2 while creating a perfect manipulation range above that previous range high. That needs to be a distribution model in case of a bearish PO3 or an accumulation model in case of a bullish PO3. Now, to add to that, the more aggressive the breakout, as you can see right here, this aggressive push up, the more cautious you need to be for a PO3. And this is truly a shift in mindset. Whenever you have an aggressive break up from the range, but you're still inside of your DL2, you need to be extra cautious for a potential PO3. This is because a lot of retail will get extremely bullish immediately because you're breaking out, while smart money makes benefits of that thought to create the PO3, to create the distribution in the manipulation phase, and then reverse price back down. And what I said in the beginning of this lecture, that PO3s are traded in the exact same way as a normal distribution, now makes a lot of sense, because the entry in a PO3 is in the distribution model in the manipulation range in case of a bearish PO3, or the entry is in the accumulation model in the manipulation phase in case of a bullish PO3. Okay, so you have a range, you want to aggressively break out of that range, stay inside of your DL2, create a new range that then has a valid distribution, and then you enter on the third tab of that distribution model like you are used to. But now, if you are aware of a potential PO3, you can target the range low of the PO3 range low and not just the local manipulation range low. That is the difference. You can extend your target. There are two exceptions I want to talk about, which I see more often than not, okay? And that is whenever you have a potential PO3, price tends to sometimes put in a two-tab schematic. Now, what is a two-tab schematic? It is simply that price creates that range in the manipulation phase that we want, but it only deviates the high once and then already reverses back down, never putting in that third tap to validate a distribution model. Whenever we have this and the return to zone is extremely good, so you have an extremely good return to zone inside of the range, while also a good return to zone inside of the distribution model in the manipulation phase, you simply have to enter on the break of structure back to bearish inside of your original range value. So you just simply enter as if it was a third tap, but it's only a second tap. Now, the other exception is that price sometimes likes to put in an internal TCT schematic. Now, what is an internal TCT schematic? It's simply that you create the range inside of the manipulation phase, but instead of distributing, taking your main range high, you have your own distribution model in the upper section of the range, but you never take that high. Okay? This also happens more often than not, so I had to mention it, and you guys need to be aware of it. And again, the entry in here is simply on the internal distribution model. And sometimes you'll even have a scenario where your exception 1 and 2 are combined, where the second tap of your internal distribution model actually sweeps that main range high, meaning you have a 2-tap schematic, but the second tap is part of its own distribution model. You guys know about TCT model within TCT, so it's simply where you have a distribution model, but the second tap of the distribution sweeps the main range high. Now, this is something you guys just need to be aware of, because then it's still valid to trade, okay? Now, sometimes in case of a two-tap schematic, you do have the risk of getting stopped out in case the manipulation phase wants to put in a model 1 distribution, but that is simply when you have to take the L to get the W. But if you focus on having that proper return to zone inside of the schematic and inside of the PO3 range, you will not have this issue, okay? Now, going into the expansion details, we cannot talk about expansion requirements. And the reason for that is because the entry is in the manipulation phase. So you're not entering on the break back inside your PO3 range somewhere in here. No, you're entering in the manipulation range. Therefore, your expansion cannot have any requirements because you're already in the trade prior to the expansion happening, okay? Now, a funny detail that I wanted to mention in this lecture is that I tend to notice that sometimes there are good-looking supply zones hindering price or potentially hindering price from having that aggressive reversal back up. Now, this is actually not that bearish, okay? This is not that bearish because you want to have a good return to zone. And obviously, if you have a supply zone, that hinders your return to zone because it's resistance. But what I tend to notice is that that supply zone is placed there to trap retail into thinking a lower high is going to take place there following the overall downtrend. Because the people that are not aware of PO3 schematics or range formations, or I should say proper range formations, they will see that price is trending down, making lower highs and lower lows. And right there in that supply zone, which is most of the time also confluent with retail resistance, they will try to short the lower high there and get absolutely wrecked and liquidated once price starts its aggressive expansion towards the upside. So if you see a supply zone that could hinder price, if you do have all the other requirements getting met, don't let that hinder you for not taking the trade, because you'll probably see that you get a tiny rejection followed by a continuation completing the schematic. Now, a few details regarding the expansion phase itself. I want you to be aware that even though the expansion phase tends to be very aggressive, it is allowed to consolidate, to go up, consolidate, potentially even retrace before continuing higher. It doesn't have to be one straight shot up, okay? You will see scenarios where it is indeed one straight shot up, but it doesn't always have to be that. It can come up, it can consolidate, it can retrace a bit before continuing aggressively higher. However, the moment you're continuing higher, that tends to be aggressive. But in the meantime of going up, you could have some consolidation / retracement within the expansion phase. Okay? So don't think that you have to exit the trade the moment you start consolidating or retracing. No, that is also completely fine. Now, last thing I want to mention before we're going to dive into the live trading examples is that whenever a TCT model fails, I want you to pay attention to the potential creation of a PO3. Because if you put your focus on identifying high probable TCT models, which are explained inside of the Discord server, the reason that price is behaving that way, creating a potential model one, having a good return to zone, that is not for nothing. So if your model one fails, even though it was confirmed, instead of immediately giving up on the idea of shorting, you want to look at price from a POV where you have to ask yourself, okay, what could be some extra manipulation that the market maker could potentially do before indeed completing the reversal back down that I was initially expecting. And this is truly a shift because like sometimes you'll be short and maybe you even took a loss on the reversal back up and that loss hurts you and you immediately give up on the idea of the short playing out. Well, sometimes the idea of shorting was good. It was just the moment of entry that was one moment off. And then you have to be aware and you have to stay looking at the charts objectively because the market maker could manipulate price just for a bit more before indeed completing that initial idea. So when you have a distribution model, could be a model 1 or a model 2 that is looking extremely good and it fails, I immediately want you to flip the switch of, okay, we could be potentially having a PO3 here, especially if we break out aggressively after confirming a good-looking TCT distribution model. I want you to be extremely cautious and not switch and flip bullish, but identify, okay, we are still inside that DL2. Let's look for a potential PO3. Okay, so don't give immediately up on the idea as long as you are identifying high probability distribution or accumulation models and look for a potential PO3. Okay, now let me take a sip of my water and let's dive into some live trading examples. So, starting off with CRV, I have already put it on my chart. So let's go over what you are currently seeing on the chart. Now, what you're seeing is you're seeing a range right here. You're seeing manipulation below, and then you're seeing the expansion up. So I immediately just wanted to show you guys a live example on the chart where you can see the PO3 in full effect, where this is obviously a picture perfect model that has a beautiful accumulation model 1 going into a model 2 right here in the manipulation phase, a good return to zone in the range while having a very easy aggressive expansion up. But let's see my thought process behind putting this range on my chart. So price was trending down very aggressively, making lower highs and lower lows. And we can see that right here between this lower highs and lower lows, you can see that this lower high and lower low is getting way more extended, meaning price is not trending down that aggressively, and we might have a potential range in the creation. So when we're trending down, we pull our range from low to high right here, and then we'll see that price has a range low, if I can put it on the chart, has a range low, has a range high, and here we actually deviated our range low, showing our first signs of a potential accumulation. Now, from there, we actually going to extend that range low to the deviation low, and we see yet again another deviation, indicating a potential Model 1 accumulation. Now, we never broke high time frame structure back to bullish, never really confirming the accumulation, and then we ended up breaking down. So, like I just said, instead of giving up on the idea, look for a potential PO3. And then the first question is going to be, okay, does this range have a good return to zone? And we're going to look at this range right here. This would be our range. Do we have a potential good return to zone? Now, I want to clarify, and this is something I should have said in the beginning. When I'm trading a PO3, I am mostly trading PO3s on the high time frame. Okay, so I would say my requirements, if you want to have like a rule of thumb, I'll kind of use them on 4-hour ranges minimum. Okay, and that is referring to the range part of your PO3. The manipulation range can be on the lower time frame, but the range itself will most likely be a 4-hour plus range. So I'm not trading this on the low time frame at all. Okay, at all. It will mainly be on the higher time frames. Now, we're seeing right here that we have these lows which are stacking up to becoming lower highs and lower highs and lower highs, lower highs, lower highs, lower highs, lower highs. So if I had to draw a liquidity curve right here from low to high, you can see that we can connect these curves beautifully right here, indicating a good looking return to zone. We do have some supply zones inside of this curve itself, but because we are trading the higher time frame, you do not have to have zero supply zones along the way. As long as you can see a curvature effect coming down, that is already good enough. So right here, we broke down aggressively from our range. And let's check, did we stay inside of the DL2? Because that's something you should immediately ask yourself. And you can see we had so much more room towards the downside while still staying inside of our deviation limit. So yes, we broke down, but we're still inside of our deviation limit. Now let's check for a new range creation and look for the requirements inside of the manipulation range. So we can go now on the lower time frame, and we can see that we broke down from the range, therefore pulling our range from low to high, and we can see this is what we currently have. We had a range low. Let's make that red. We had a range high, and then we had our deviation 1 showing signs of an accumulation, and then we had our deviation 2 indicating a potential model 1 accumulation schematic. So now, looking at the requirements that we need to have for a manipulation range, we can see, okay, we're inside of the DL2. We have an aggressive breakdown. We have a perfect manipulation range below our previous range low right here. We just back tested it on that range high. We have a valid model 1 accumulation that's actually, looking at the model itself, an extremely good looking accumulation model, having nice trendline liquidity above right here. So this could be a potential PO3 schematic. So what we're simply are going to do is we're going to check, okay, when did this schematic confirm itself? So let's go on the lower time frame. Let's see right here. Let's go on the 30-minute right here. You can see that you want a break of structure that is back above, okay, your original range value low, which is this horizontal line right here. So even though you broke structure right here on the 30-minute following the 6 candle rule, I would not enter on this break of structure. But what you could do is simply wait for the second break of structure that is back inside your original range. Look at that. So right here, you had that break of structure back inside. You've reclaimed that range low, and now you can enter on the break of structure, put your stop loss below the low, and target that range high. Now, originally, you would have a trade setup that looks something like this, which is a 3.6 risk to reward, which is a decent risk to reward, but it is a pretty high time frame setup. So if I'm trading the higher time frames where my trade, plays out in a span of 18 days, I would like a better risk to reward. However, we know that this manipulation or this accumulation play could be part of the manipulation phase of this macro PO3. So we have the potential to extend our target all the way up towards the range high of our manipulation phase. See how the entry is the exact same, you just extend your target. Now, what happened from here is that instead of immediately breaking out, price ended up deviating that high, coming back down, consolidating, and kind of confirming that this model 1 went over in a model 2 with sweeping all this liquidity or all the mitigating all the demand that we left behind right here. Also sweeping liquidity, reaccumulating before going up higher. And this is immediately an amazing example. Look at that. Let it play out real quick. There you go. And now you start your expansion phase. So you can see the price actually ended up coming back for that entry, sweeping all that sell side liquidity right here. First high time frame market structure low creation, therefore making it your extreme liquidity, and therefore also showcasing that this model 1 accumulation that you entered on went over into a model 2 accumulation right here. And this is already an amazing example because it goes to show you that if you're trading a PO3, you don't need to have immediate follow through from that range break. It is obviously preferred, but here you can see an example where, price had to come back down first before putting in another higher low, sweeping more sell side liquidity, giving the market maker the opportunity to fill more positions before squeezing aggressively back up. So the moment price was ready to break out, we had an aggressive breakout right here, and price simply never looked back. You can see I'm on the 12-hour. You made higher lows and higher highs, and you squeezed up so aggressively. And the reason why you squeezed up so aggressively is because you had that good return to zone where all these stop losses were getting triggered, making price, causing buy orders, and therefore making price pump up higher really fast. So you can see right here in a high time frame example where you could have easily predicted this 500% move on CRV because you had this range, you had the manipulation below, and you had the expansion away. Okay, so right here, amazing example of a very high time frame PO3 model where you have the range, where you have to return to zone. The model 1 failed. We immediately look for a potential PO3. You have your manipulation phase that end up being a model 1 accumulation going over in a model 2 accumulation where you enter simply based off the TCT model, as you guys know, and then you simply take it potentially towards that range high, just like this. Boom. And the expansion is that followed. Absolutely amazing example, guys. Now, let's head into some more examples. Let's grab the Bitcoin chart, okay? And we're gonna use a very funny example because the bear market low in December and November 2022 with the FTX collapse, that was a PO3 schematic. Yes, I know you're probably thinking, if only I knew it back then, I would have made so much money. Now you know it now, and they're going to be way more opportunities in the future. Okay? So, looking at this price action in the bear market, what can we see? Well, obviously, we can see that price is trending down very aggressively, making lower highs and lower lows. But we can also see that, from this low to that low, it took a very long time. It's not really price trending down very aggressively. In other words, we probably have a high time frame range here. Okay, now we're trending down, so we pull our range from low to high, and then voila, we have our beautiful range low and our beautiful range high right there. Okay, now we can see if we look on the high time frame, we have a valid 5-day range. It is a high time frame range, And right here, November 2022, we had the FTX collapse and we came down very, very aggressively. But what did I tell you guys about coming down so aggressively? Let's go back to the example. The more aggressive the breakout, the more cautious you need to be for a PO3. So while the entire market was stressing, thinking that we're going to reach targets of 8 to 10K Bitcoin, we were simply setting ourselves up for our macro bottom. Because right here, you can see that we came down aggressively and we closed below. And what followed from there was a manipulation range. Let me go back in time right here. Just like that. What followed from that breakout was a range formation right here where price came down, came back up. Let me put this to the side right here. This was our range. Right there. That was a range. Price came back down, moved back up, and then created a new range. Okay. Or right here, we deviated that range low. And later on, we came back for extreme demand here. I realize I'm on that BTC USD Bybit chart now, but on the other exchanges, we did actually came back for extreme demand, validating that this is going to be an accumulation model 2 accumulation, while having a proper return to zone, just like this. That literally was the accumulation model that was the bear market low. Now, one thing that's differentiating from this potential PO3 from others is that the return to zone in this range was not the best. Okay. And I want to clarify that if we are trading macro PO3 models, you can be a bit more flexible with the requirements of the return to zone in the range. Because like I just said, this was a 5-day range, which is absolutely an extremely high time frame. Because I said the minimum is 4 hours. So if you are trading these 4-hour ranges, yes, you want to have a good return to zone. And we're going to come into examples where we do have that amazing return to zone. However, I want to show you everything and not just the picture perfect textbook schematics. So if you are in key POYs where you're expecting a potential high time frame bottom and then you have a good range formation and you're meeting the requirements, but the return to zone isn't the best, you can still use it. Okay, so right here, the range wasn't meeting all the requirements from a return to zone perspective, but we did have that manipulation phase right here that did meet the requirements, because let's check. Was this range a breakout? Now, we can see our manipulation phase stayed inside of our DL2. So that is a check. We had an aggressive breakout. So we need to be more cautious for a PO3. That is a check. We have a perfect manipulation range that has a picture perfect model 2 accumulation schematic right here. You enter on the third tab of the accumulation model. And then just like we saw on CRV, price came back up, but we deviated our range high. Okay, so we came back up, deviated our range high, and then price ended up coming back down for more demand before actually going higher. So you can see it kind of also a pattern with these macro formations, because the same way that CRV came back down to sweep more liquidity before completing the expansion phase, the same way that Bitcoin right here came back down to mitigate more demand before completing the expansion phase. And we can actually see something pretty interesting right here regarding this PO3, and that's because we did not immediately have one straight shot up to complete the PO3 formation. With the expansion phase, you can see right here a prime example of price having its first run up, then distributing, cooling down, coming back lower before completing the schematic. And that is completely fine. Okay, that is completely fine. You can do that very easily. You don't have to have one straight shot up. It can cool off, it can retrace before it can continue itself. And now that I'm saying this, it is very funny, but I realize that right here we have another PO3 schematic that I initially was not going to use in the lecture, but now obviously I will because I'm seeing it. So, and this also has even another advanced detail where you can have a PO3 schematic on the lower time frame inside of a bigger time frame PO3 model, which just adds extra confluence because the context is that price needs to come to this range high. So the same way that I talk about, context building within TCT models, if you have a confirmed PO3, which is confirmed the moment we break out right there, price is going to reach that range high target. So if you have another PO3 in here where I'm referring to this PO3, and we're going to go into the details in a minute, this PO3 is extra good to trade because price, the order flow objective of the move, is to come towards that main range high, which we haven't hit yet. So you're trading a bullish PO3 in already a bullish context, in a bullish environment. Okay? This needs to be the manipulation phase. Right there. So in these situations, obviously, if you're inside of a bigger PO3, you can extend your target because price has to come there either way to complete the bigger PO3. And that's where you can kind of combine the two, right? Which is an advanced detail I wasn't really going to talk about, but it was inevitable talking about these examples. So going into the details, let's see what we have and if it actually meets all the requirements that we always talk about. So let's zoom into the price action right here and go on a lower time frame, like in this case, the 6 hour. Okay. So what we have right here is a beautiful range formation. Okay. Now, how this range originally started was you had your range high, you had your range low, and then you deviate the high multiple times, extending our range high to the last deviation high. We had a reversal back down, probably some sort of distribution model there, and then we broke down. And you can see that we broke down very aggressive. Okay, we broke down very aggressive in this very bearish candle here, the 9th of Feb 2023. However, we came into this key demand zone right here on the left, which is structure demand. The overall context was also still bullish, and you can see that you have your DL2, and we're not closing convincingly below that DL2 while coming into demand. And as you guys know from the lecture, if your DL2 is literally aligned with a demand zone, you just don't want to lose that demand zone. Okay, you can have a tiny close above your DL2, but it's simply because you're mitigating demand. And you can see right here, you don't have convincing closing candles below that DL2, still making it a potential valid deviation. Okay, but that's all explained in the DL2 lecture. So we have a range here, and now let's look at the range itself because this is indeed a lower time frame range. So now we do want all those range requirements, which is a return to zone, to be met. So this is our range. Now, does this range have a good return to zone? We can see this range has an amazing return to zone. You have all these highs here stacking up to be lower highs, truly leaving no supply behind. And this is truly what we want to see if we're trading these lower time frame PO3 schematics. Okay, so you had a beautiful return to zone inside of the range itself, making it for a very easy move up in the future if we do exceed these price targets. Okay, so we have a range, we have a breakdown, and the range meets all the requirements, so we need to be aware of a potential PO3. Okay, now let's look at the range that gets created in the manipulation phase, because what we can see right here is we can see that price is coming down, we're coming up, and then we swept that low right there. We're coming down, we pull our range from low to high. And what can we see right here? We can see we have a range low, we have a range high. Now we can go on the lower time frames. And you can see that price has a model 1 accumulation schematic with a 1, with a 2, with a 3 right here. 2 deviations, each deviation going lower than the previous one, truly showcasing a model 1 accumulation. We also have a decent return to zone inside of the range itself, where price is truly curving down right here. Nice return to zone. And then your entry is on the breakup structure like you normally would enter a normal TCT model right here. Let's go on the lower time frame. Right there. Here you can see we're breaking that market structure back to bullish after putting in that third tap. Right here you can see that most local structure making lower highs and lower lows, turning back to bullish right here. And then that is your entry. However, now stop loss goes below the low. That all stays the same. But instead of your target now being your accumulation high, which is already a decent risk to reward of around 3.25, you can potentially target the range high of your PO3 schematic, extending your RR and increasing your RR from around 3 to over 16. Or then this is the entire manipulation phase. And now we could have a potential expansion back up. And we can see price ended up absolutely squeezing through. Now, also when I'm trading on these lower time frame models like the 4-hour, I like my range to be completely below my manipulation range to be completely below my original range of the PO3. So we can see that on the higher time frame, it was kind of combined. You're kind of, your range high right here in the beginning is kind of exceeding and coming into that original range from the PO3. Right here, you can truly see that you have your own manipulation range. It's completely below the range of the PO3. Okay, I like that more. But as always, when you're trading the lower time frames, when you're trading lower time frame schematics, you need to be more and more strict. And when you're in the higher time frame, you can be a bit more loose with the concepts, okay, or with the exact rules. You can be a bit less strict. But here you can see a prime example of a lower time frame schematic where we have a range, we break down aggressively, coming into potential support, stayed inside of that DL2 area, combined with high time frame support while being in that higher time frame PO3 schematic that did not hit its target yet. Let's not forget. And you have an amazing schematic in front of you. But you can see instead of just simply trading this low time frame model 1 that all of you now already can based off this mentorship, you can extend your target to all the way to the range high, increasing the RR from around 3 to 16, which is almost it's more than a 5x on your return, simply by understanding context building through the POV of a PO3. Okay, now Bitcoin has even way more, because I also want to show you guys some examples of different types of manipulation phases where you have those exceptions. So right here, and this was actually my first trade of the year 2024, what we can see is that we have a high time frame range. Okay, so price came up aggressively, came back down, we're trending up. You can see we have a clear uptrend. We're in the bull market, and in an uptrend we pull our range from high to low. Okay, pull our range from high to low, and right here we have our range. Voila, boom, this is our range. Now right here price is breaking out of our range. Okay, so we immediately need to be aware also of a potential PO3 formation. Now, what can we see right here? Do we have a beautiful return to zone? Yes. Right here, you can see that you have all these lows that are stacking up to be lower or that are stacking up to be higher lows, where you simply have this wick low, that wick low, that wick low, that wick low, and then all these lows, they're slowly right here grinding up, leaving a lot of sell side liquidity behind. But the most beautiful part about this range is that we didn't only have the liquidity below. Like I said in the examples of your range, you also had liquidity above right here. Okay. Now, like I said here, it is even better if you have price compressing within the range, building liquidity on both sides. And that is exactly what we saw right here, where you have the range and you're building liquidity below while also building liquidity above. And then when you have that first move, following retail patterns, the first move tends to be the fake move, because a lot of people will look at this and they will talk about this being some sort of like a bull flag or whatever they would like to call, and they target way higher. And then the market makers benefit off that retail pattern by making the first move the fake move, reversing back down, liquidating all of them before actually moving higher. But right here, we can see an example where price has that range formation and we are compressing inside of the range, and then we decide to move in towards the upside direction. So already when you're starting to move and break out of that compressing effect and that retail pattern, you need to be extremely cautious of the move, okay? Instead of being bullish, become more cautious. Now, right here, we have the range. The range meets all the requirements. The range actually, has an extra benefit to it. So it definitely meets all the requirements for a potential PO3. Now, let's look at the manipulation phase right here. Let's look at the manipulation phase right there. First, did the breakout exceed the DL2? Now we can see right here, no, we didn't. We stayed inside of our deviation limit, never even touching our deviation limit area. Therefore, this is a valid potential manipulation. Now, let's zoom in to the range that got created right here. Now, what you can see is that on the higher time frame, price is right here. Price is moving up, moving down, and then we had to move back up, okay? Making this your range formation right there. Let me, put this a bit to the left. There you go. And now let's look at this range. So this is your manipulation range, okay? This is your manipulation range. Now, here we can see an example that we had a manipulation range, and we had a range high, and we had a range low, but our range high never got taken. So we never had a distribution model properly like we would prefer, okay, with deviating that range high. But if I zoom in on the lower time frame and I get rid of this equilibrium to kind of clear things up, otherwise it gets a bit messy, you can see that on the lower time frame, we did indeed have price trending down here, making lower highs and lower lows, having its own little range here, where this range was actually a low time frame accumulation right there with a 1, 2, and a 3 that turned into a Model 1 distribution schematic right here. So we have the range, you had a Model 1, you came to the range high target right here, and you turned that accumulation into a distribution. So here you can even combine the concepts I've given to you where, an accumulation can turn into a distribution, because we have the potential of a PO3. So you are in generally more bearish than bullish. And you can see we had a PO3 here where we did have a distribution, but it's one of these examples where we had an internal TCT schematic where you had a distribution model, but you never swept that initial range high. Right there, exception to in a live trading environment. Now, this was actually an absolutely insane trade because we got a very refined entry within the model itself right here. Right here, we broke structure, supply creation right there. And I remember actually shorting this with my stop loss on that break of structure retest above this supply zone, and now we can simply not only target the range low of this distribution model in the manipulation phase, but we can actually target all the way down to this low. And this brings me to another great point, and this is what you'll see, nothing is always textbook. Nothing is always textbook, and that's why it's so great showing you these live examples that price dumped down very aggressively, like come on now, very aggressively. But as you can see, we never swept our range low. What we did is we swept the extreme liquidity inside of the range, and therefore I want to encourage you guys to have multiple take profit orders. See where the liquidity is resting inside of the range and scale out from these lows. Set 1 limit, set 2 limits, set 3, set 4, set 5, and scale out that way. And not only set 1 TP, otherwise you could get front ran really hard. And you can see this was an extremely fast move. If we go on the lower time frame, it was such an aggressive wick that immediately shot back up over 6.66%. And if you don't have those limits to scale out, you could get your TP front ran and lose out on amazing profits, okay? But here is a prime example of having a range, deviating above, staying inside of that DL2, and then having a valid manipulation play using exception 2, where the range had a perfect compressing effect, adding to the likelihood of your PO3 playing out. This was absolutely an amazing trade. I remember this was my first trade of the year. So absolutely amazing. Now, let's continue, because what we recently had was the exact same play. Okay, what we recently had was the exact same play. So remembering that situation that we had right there at Jan, so the example I gave to you was the example right there, we recently had the exact same on Bitcoin. It was the exact same, guys. So you can see these market makers truly play the same play multiple times. So price was trending up very aggressively, making higher lows and higher highs. When we're trending up, we pull our range from top to bottom, just like that. Pull our range from top to bottom. And we have our range right here. Now, what can we see is price is building up beautiful liquidity above while also building up beautiful liquidity below, right? Liquidity below is getting built up, connecting these lows here. Liquidity above is getting built up. So we have a range that has this compressing effect in a very bullish market environment, because this pump was the pump that brought us to 6 figures. Therefore, setting itself up for the perfect manipulation play, because if Bitcoin hits 6 figures, it's going to be all over the news and everyone is going to get bullish, okay? So we can see we have this range, and this range obviously meets all the requirements like we just discussed. It even has that extra requirement of contracting and compressing inside of the range. Now, we broke up very aggressively. Now, let's check our deviation limit tool. Now, okay, on the 4-hour, we closed above, but this range is also valid on the 18-hour, and on the 18-hour, we deviated it. So obviously, high time frame overrules low time frame. So if we deviated on the high time frame, but the range is still valid on that same time frame, it is a deviation, and it's inside of the DL2. Okay, so we're gonna drag this to the left, and we're gonna look what did that manipulation phase look like. So right here, we can see the same thing where price creates a range right there. We create a range. Let's get rid of this EQ. And you can see that you never grabbed your initial range high. You had your range high, you had your range low, and you never grabbed the original range high. But what you did have right here was a range formation inside of your higher time frame range, and with the higher time frame range, I'm referring to this bigger manipulation range that did have its Model 1 distribution schematic that you could have traded. So going on the low time frame right here, you can see your entry would have been initially you wicked it right there, and then you wicked it again, but you did get that break of structure over here. Boom, break of structure. And right here was your short entry. Your stop loss could have gone above that distribution high, but instead of targeting this local range low for only a RR of 1, which would not have been worth it to take, you know that you can potentially get a full-on reversal back down all the way to the PO3 low, increasing your RR by 20 from a 1 RR to a 20 RR simply by understanding this advanced way of building context. So right here, this would have been your manipulation, and it was also a beautiful range fully above that original range from the PO3, not connected in any kind of way. And then you had that aggressive expansion towards the downside right here. Boom. Connect that. There you have it. Look at the outcome. Boom. And look at the aggressiveness of the move. And this is what I'm saying. These PO3s, when they move, they tend to be very aggressive because it's such an aggressive manipulation play. Right? So many people got trapped here. I can turn on my volume for you guys, and you can see the amount of volume that came in the moment price was breaking through that high. Look at this massive volume spike the moment we broke through that range high. That is people opening up long positions because most of the liquidity was already grabbed on this move up, right? Most of the liquidity inside of the range was already grabbed on that move up, which resulted in this volume spike. So this volume spike was people actually getting stopped out, but that volume spike was people opening up long positions. This is not just a theory. Retail actually opens long positions, and this was obviously the ultimate trap because it was around that 100K area, which is like a massive milestone. And you can see the volume spike that resulted, which is literally people getting liquidated. Okay, I think around 1 billion got liquidated in the crypto market on that push down. But this is how you could have traded understanding PO3 models. Okay, now I have 2 more examples I need to show you guys. And first, I want to show you an example of exception number 1, which is when we're putting in a 2-tap formation. And gold, in my opinion, was an amazing example of that. So overall, gold was trending up very aggressively. Now you can see, I don't have to draw that. You can see we're in a very aggressive uptrend. And the trend is your friend until the end of the trend. So we kind of had price making higher lows and higher highs right here. So overall, we are expecting a higher low. And obviously, context stays important, guys. Context stays important. Now, we have 2 levels of market structure. We have this move up, and then we also have structure from the top down going lower. And you can already see when I try to draw the structure, which represents our level 2 market structure, this is a very broad lower low. And therefore, we can pull our range from top to bottom. We're in the downtrend, pull our range from low to high. And you can see right here that we have a range formation. Now, right here, we have our range. And then price breaks out very aggressively from the range. And every time you have that, you immediately need to think, okay, can we have a potential PO3? If you're going to have an accumulation model, you will deviate the low, but you will not be breaking it this aggressively. Like, look at the aggressiveness of this break, right? Of this move down, of that candle. So whenever you see such an aggressive move down, immediately think PO3, PO3, PO3 potential. We have this range. Now we're trading on the 4 hour. So, this is like the minimum that I want. And therefore also, since it's the lower time frame, according to PO3 models, we need to have, all the requirements meeting up. So we can see, do we have some sort of a return to zone here? And yes, we have an amazing return to zone where you can see all these highs are building up right there. It's a beautiful liquidity curve right here, where price is truly coming down, leaving all these highs intact, followed by a massive inefficiency of this aggressive move down. So this range meets all the requirements. Then we have to check, did we stay inside of our DL2? We turn that on. Would you look at that? We wicked our DL2, but we never closed below it, making this a valid deviation still. Okay, even though the break is this aggressive, it is a valid deviation. So now we're going to go on the lower time frame and we're going to look for a range creation. And look at that. Again, these are the best range creations when you're truly below, okay, truly below the range low of the range of in the PO3. If that manipulation range is below that range of the PO3, that's always extra perfect. It's like picture perfect, right? So right here, we can see that range, and we have our range low, we have our range high, and this could be the manipulation part, okay? Now, what you can see right here is that price on the lower time frame right here. We swept that range low incredibly fast, okay? Swept that range low incredibly fast right here, and then fully reversed back up. Now, this was actually a news event, right? This was actually a news event. I remember it very well, where at 2:30 p.m., we got a news release. Price came down, swept the liquidity of that low, and swept that range low and fully reversed back up. So it was harder to enter this. You had to enter on news on the lower time frame, which is always riskier. But it just goes to show that news completes where liquidity is. So we had a lot of liquidity below. News sweeps that and then reverses back up, completing the schematic. I'm always a big believer in the fact that, you show me the price and I'll tell you what news is going to be. Okay? News doesn't just randomly reverse price, it always seeks liquidity, which is what we had here. But you can see we had a range, it has a return to zone. We deviate the range low inside of the DL2. We have the range formation. We tap that low, and then we fully reverse back up right here. And this also, again, a great example of the fact that your expansion phase doesn't have to be one straight shot up. You can see right here that we took some time. We moved back up, we consolidated before completing the schematic and going higher. And again, taking high time frame long positions in these places are all very good ideas, because you're trading in the context of the fact that price eventually will come towards that high, right? So sometimes, when you've missed the PO3, don't be sad, because now you know what the context of the chart is going to be, which is bullish, and you can search for lower time frame entries for higher time frame targets. But again, guys, you can see an example of a PO3 here where you have the range, you have the manipulation, you have the expansion, but it was of exception number 2, which is that, or exception number 1, which is that 2-tap formation. Okay? Now, the last example I want to give you guys is another example on Bitcoin, which is one of the examples I took most recently, because I didn't manage to catch that one, and that was right here. And this was truly such a beautiful model, where right here we were in this macro range. Just to build some context, we were in this macro range right here. We deviated that 49, or we deviated that range low, hitting that 49K. A lot of people stressing out. We came back inside, and what a lot of people were doing, okay, what a lot of people were doing is they were drawing upward structure. I remember this very well. We had a high, higher low, higher high, and people were drawing this as structure. But when I'm showing this to you guys, you should already immediately see that this is not just upward structure. As you can see, there's already a major difference in this first market structure pool that broke market structure right here, and the second one. Because the first one actually looks like V-shaped market structure, where if you had to pull a range here, you can clearly see that price broke out of that DL2. Whereas if we apply that to the second so-called breakup structure by the market structure experts on social media, you don't have that. Matter of fact, you have a range formation right here. This is a range formation. And then price, quote unquote, breaks out aggressively, whereas a lot of people become very bullish, talking about a higher low for a higher high, while price is simply coming in supply, tapping into that DL2, never confirming a breakup structure, but instead still being in the valid deviation limit area. And we are going to look for a PO3, because we break out aggressively, so our bells immediately start ringing of, okay, we could have a potential PO3. Now let's look at the requirements. And we can see that from all the examples that I've shown you guys, this was truly the ultimate return to zone that you could have asked for. Okay, this was the ultimate return to zone. Truly, this is picture perfect, where all these lows, guys, all these lows were just stacking up to be higher lows. You have one low here, one low there, all these lows, not even just market structure lows, but those just random wick lows. They were all stacking up. Like every single one was stacking up, making literally a picture perfect liquidity curve. And therefore, we definitely need to be aware of a potential PO3. So we have the range here. The range meets all the requirements. Now let's look at our manipulation phase to see if we can short and trade the PO3 formation. So what we did is we aggressively pushed out of that range, and then we started a new range right here. Voila. Let's move this actually to the left so we don't have that in our way. There you go. And then we have this range. Let's keep that a range. And what we see is we have our range high, we have our range low right there. And price comes close to the range high. Oh, I should put it like this. Okay. Range high, range low. My apologies. Range high, range low. And then price comes close to the range high, but it doesn't sweep it. And what we actually had here was a model to accumulation schematic where we had to pull our range from low to high following that local downward structure, like you can see right here, lower high, lower low, while also having this range from high to low. You can have two range pulls based on your two levels of market structure, as you guys know. And this is then what you would have just like this. And you can see that this accumulation model went over into that model 1 distribution schematic right here. Okay. And now we can go on the lower time frame to look for a break of structure. And right here, we can see price breaking market structure back to bearish. Where again, we have a scenario where we have that distribution model in that manipulation range, but we didn't sweep that main range high. And that is again that exception to with an internal TCT schematic. Okay. So what you can do is you can short the break of structure right here. Your stop loss, as always, goes above the third tap high. But instead of targeting the range low, which would have only been a 1.5 RR and not really that valid to take, you can now target the main range low from the PO3, increasing the RR from 1.5 to 15. Okay, guys, that's a 10x increase in your return. And look what happened. We had the manipulation range right above. Absolutely beautiful. Again, also here, it was a quote unquote lower time frame range compared to the macro ones we've seen on like the 3-day and the 5-day. And therefore, we need to have that proper return to zone. And I also want a proper manipulation range above that original range from the PO3. And then right here, you can see the expansion towards the downside. And also here, it's a prime example. Expansion. It's a prime example that it doesn't have to hit the target in one go. Okay, it doesn't have to hit the target in one go. It could easily come down, or they liquidate a lot of people, range for a bit before actually hitting the proper target. Okay, it doesn't have to be one straight shot down. Like I said, it can dump down, it can consolidate, and then it can continue its way down. So you can see that it doesn't happen that often, but when it does happen, they tend to be amazing moves. You know, we can see different PO3 schematics in here, and we had different ones in here as well. Also one in here, like I've shown you, and you can saw this one or see this one on CRV and the 2-tap schematic on gold. But I hope with also showing you properly all the examples, you kind of have a good feeling right now as to when you could potentially use it. Because if I had to summarize it properly, I would say you have a range. You see that return to zone building up in the range. Originally, you'll always be looking for a TCT model, but if price then breaks out of that range aggressively, that's when the bell should be ringing of like, hey, we could have a potential PO3 here. And that's when you start looking for the requirements in the manipulation phase and then potentially end up trading the PO3 by entering in the manipulation phase on your TCT model. And now whether that's a two-tap, an internal TCT model, or a picture-perfect one is obviously depending on what the market wants to give you. But this is basically all that you need to know to be trading PO3 models. Again, guys, this is an addition to building context and extending the target of a potential already existing TCT distribution, or maybe even trading a distribution or accumulation model that you originally would not have traded because the RR was not good enough. Okay. But don't start switching up your entire trading style now by wanting to trade PO3 schematics only, because they don't happen that often. Okay. It's an addition. It's an addition to your already current existing knowledge. Okay. So I will continuously be improving this mentorship by posting more and more lectures, with the months that come by, to truly prepare you guys for every market scenario and make you all a profitable trader. If you like my style of trading, if you like my style of explaining, I trade live inside of the TCT trading community that you can join with the link inside of the bio of this video. Okay, I appreciate all of you guys for watching, and I'll see all of you in the next one. Peace out.